A warm welcome to all students to Mickey's classes. Today we are going to cover the money measurement concept. This is one of the concepts which is covered in the CBSE Class 11 Theory of Accounting Chapter 2. This is a part of that. What is the main concept of that? The main concept is only those transactions and happenings which can be expressed in terms of money is what will be recorded, is what is important for accountancy and for record keeping of accounts. So a company will get into a lot of transactions in which they'll be dealing with money, right? They'll purchase some product, that will be in terms of money. They'll pay salary to their employees, that will be payment in terms of money. But there might be other transactions. Okay, let me just give you one or two examples. Yeah, so they can be most of the transactions which a company gets into will be monetary transactions. So transactions of a company. It can be monetary, like for example, salary payments to all its employees. It can be selling some products and getting money. It can be advertising their products, in which again they have to make payments to the advertising agency, etc. Right? And there can be non-monetary transactions also. Those can also be called as transactions, but those are not important for accounting. Like for example, a new manager has got appointed. There can be plenty, numerous examples. I'm just giving you one or two examples so that you understand. A new manager has got appointed. So in monetary terms, this might not be a monetary transaction. I know the company has to pay him salary, but for now, only the appointment has happened, right? When it comes to paying the salary, that's a monetary transaction. Customers say good things about the company. Sorry for the writing again. So this is again non-monetary, right? Customers are saying good things about the company, but that at some later point will generate revenue for the company. Maybe if customers are happy, they'll come back to the same company, they'll buy products from the company, they take services from the company. It might help the company in the long run. But as of now, saying a good thing is not a monetary transaction. So in accounting, we are only concerned about this set of transactions, which are what you call as monetary transactions. Okay, now let's move on. Now, next point is all records to be kept in money terms and not in terms of physical units. So what does this mean? Let us go back to the drawing board and check. Let's say you are a company which is into the business of buying and selling clothes, which means you are basically a trader in clothes. Right? You're a trader in clothes. Now what happens is you'll buy stock from a wholesaler. You're going to buy clothes. Yeah. And you're basically a retail clothes trader. Now, when you buy your stock from this wholesaler, you can buy different kind of varieties of clothes. Like you can buy shirts. Then even within shirts, you can buy different brands. Then you can buy trousers. Then you can buy, I don't know, some vests. So I'm assuming this is a store for men. Okay. Just going by the variety which we're talking about. And there would be other items. Now, suppose you have bought 50 pieces of shirt, 10 pieces of trousers, some 50 pieces of vests, 100 pieces of some other item. Now, all of these have a different price, right? Shirts might be for a cost of 1,000 rupees. The trousers might be for 1,500 rupees. The vests might be for some 200 rupees. And these other items might be for some other kind of prices. All these which I mentioned here are the prices. Now you cannot sum up the physical units, right? What are these? What is this 50, 10, 50, 100? All of these are the physical units. So you cannot just take stock of 150. If you add all of this, how much does it come to? If you total 50 plus 10, 60, 60 plus 50, 110, 210. So you cannot just say that you bought 210 physical units, right? Because what is the reason? Because the price for each of these is different. So you cannot add 50 shirts with 10 trousers. What you'll have to do is you'll have to check how much is the value, isn't it? 50 into 1,000 would be 50,000. Then 10 into 1,500. Likewise for the trousers, 10 into 1,500. So that is 15,000. Likewise for the vests, you'll have to add 50 into 200. That is 10,000, right? Yeah, 10,000. Then 100 into 50, whatever that item is, which is 5,000. So these are the values, right? How do you find the values? You find the number of units. This is the number of units into the price. And you find the value for each item. And then you can add all of this. So 65,000, 75,000, 80,000. So that is why in accounting, when you try to keep the records, you want to keep it in terms of value and not in terms of numbers or physical units. Why? Because you cannot add up physical units of different items. But in the case of value, once you have found the value, this is all in terms of rupees, right? So you can add all of this. So that is why all records are kept in terms of value. But keep in mind that these numbers might be important. The physical units, for example, how many units of shirts have you bought, might be important. But that is just additional information. That is not the main information. The main information is the value. All of this is like additional information. Okay, I think that will make it clear to you all. And check the other points which are there. Okay, we have already discussed up till here, which is all records to be kept in money terms and not in terms of physical units. And we have discussed the reason for that too. What is the last point? There's a drawback. Now, what is this drawback? Drawback means, I hope all of you understand, drawback is a limitation, right? Drawback is a limitation. Limitation of this concept. So what is the limitation? The value of money keeps changing. The value of money keeps on changing. So the accounting records might not be a true and fair reflection of the value of business. These are very important words in accounting: true and fair reflection. So whenever you're doing whenever you're keeping records of accounting transactions, the one thing which you want to do is all of that has to be a true and a fair reflection of the transaction which happens. I'll try and give you an example and you'll understand. The purchasing power or capacity of money. This keeps on changing. So what does this mean, the purchasing power of money? So think about it. Today, if you spend 1,000 rupees, what all you'll be able to buy, the purchases which you'll make will be different from, let's say, 10 years back. This is you. This is, let's say, your father 10 years back. If he would have spent 1,000 rupees, his purchases would have been much bigger, right? Because with 1,000 rupees at that point, you would have been able to purchase a lot of more goods, a lot of more services, isn't it? And then think about maybe your grandfather. With 1,000 rupees, your grandfather might have been able to even purchase a property, a piece of land. Why is this so? This is so because of this, because of this concept. What is it? The purchasing power of money, which keeps on, this is the purchasing power of money. This keeps on changing. This keeps on changing, isn't it? And because it keeps on changing, so think of it from your perspective now. For your business, let's clear this canvas and then discuss. Okay. Think of it from your perspective. Now, for your business, suppose you had bought a building for 10 lakh. 10 lakh rupees, 10 years back. Fine. 10 years back, you had bought this building. Now this building is still there for your business, but the value of this building might have gone up to 25 lakhs, which means what? If you want to sell this building today, if you want to sell it, you might be able to sell it for 25 lakhs, but you had bought it for 10 lakhs. Why this change? Because the value of money keeps on changing. Likewise, the value of all assets, like the value of building, has gone up, right? So, but in your accounting, in your records, in your accounting records, sorry, okay. In your accounting records, your building will still show as 10 lakhs. In fact, minus something which is called as depreciation. Do not worry about this term now. We'll discuss when we come to that chapter. But in the book of accounts, this will show as depreciation. But actually the value might have gone up for your building to 25 lakhs. But your accounting record keeps it as this 10 lakhs, which is a drawback. So there are other forms of accounting nowadays, which is known as fair value accounting. Which is known as fair value accounting, in which the value of your asset will be changed to 25 lakhs. But the accountancy which we are learning here, this is cost-based, not fair value-based. Cost-based accounting. In cost-based accounting, which we cover in our syllabus for class 11, the value will still remain at this 10 lakhs and minus the depreciated value. So that is a huge limitation. That is a drawback. Because if you want to assess your business, if you want to check how much is the value of your business, you'll not be able to do that because in your books, the price of your building, the value of your building, sorry, will still remain at the 10 lakhs and minus whatever the depreciation value might be. So that is a limitation because you'll not be able to value your business properly just by checking your accounting records, because the building, which today might be at the value of 25 lakhs, might still show as 10 lakhs. And likewise for all the rest of the assets which you have. It might be some factory which you have. It might be some plant which you have. Plant meaning a plant which is used in your factory. It might be some cars which you own. So for all of this, the value actually might have gone up. But due to cost-based system of accounting, what will happen? Our value will depend upon how much have we bought that product for that particular asset for. Okay, I hope that